Welcome to The Explainer. Today, we're going to decode something called sector rotation. It's this powerful strategy that the pros use to navigate the ups and downs of the economy. We're going to break down how it works, why it's so important, and this is the really interesting part, how some huge new forces are starting to rewrite the entire rulebook. So let's start with a puzzle that, every investor has to deal with. The leadership in the market seems to change all the time. One quarter, tech is absolutely on fire. It's the only thing anyone's talking about. The next, all the headlines are about these boring defensive stocks. It can feel totally random, but I promise you there's a hidden rhythm to all of this. And that rhythm is all based on a strategy called sector rotation. The best way to think about it is you're kind of looking down from 30,000 feet. You're strategically moving your money out of sectors that are getting a little tired and into the ones that are just about to take off. The whole point? To try and stay one step ahead of where the economy is going. Now, this is the most important thing to get your head around. The stock market isn't a mirror of what's happening today. Not at all. It's more like a crystal ball, a blurry one maybe, that's trying to guess where the economy will be 6 or even 9 months from now. It's constantly trying to price in the future. That's exactly why the market can start to rally when all the economic news still sounds absolutely terrible. Okay, so let's really dive into how this works. The best way to visualize this whole strategy is to think of the economy as a clock, or maybe like the 4 seasons. Each one has a very distinct phase, and each phase favors a completely different type of investment. Big investment firms like Fidelity have mapped this out into 4 clear stages. First, you've got the early cycle. That's a recovery. Then comes the mid-cycle, which is the long expansion phase. After that, things start to slow down in the late cycle, and finally, you hit the contraction of a recession. Just think of it as each phase having its own unique economic weather, which naturally is better for some companies than others. And right here on this chart is where it all just clicks. Look at that early phase. GDP is picking up speed, interest rates are low, and profits are bouncing back hard. Now, just jump your eyes down to the late cycle. It's the complete opposite, right? Growth is slowing, inflation is getting hot, and those rising rates are starting to squeeze company profits. You can really see how one phase just logically flows right into the next. And listen, this isn't just some nice theory. The historical data behind this is powerful. I mean, think about it. During a recession, the sectors that sell things we all need no matter what, healthcare, groceries, electricity, have beaten the rest of the market a staggering 88% of the time. That is just an incredible level of consistency. This table from State Street really tells the story. I mean, look at the incredible difference. Tech stocks have almost no shot of outperforming when the economy is in a recession, only a 13% hit rate. But in a recovery, that number skyrockets to 78%. It's a completely different story. And check out financials. They are the undisputed kings during an expansion, winning 85% of the time. The patterns here are just, they're undeniable. Okay, so how do we actually turn this into a practical strategy? Well, if each economic season has its own weather, you just have to make sure you're dressing your portfolio for the right climate. All right, picture this. The economy is just starting to poke its head out after a recession. Interest rates are basically on the floor, and people are starting to feel a little more optimistic. This is the perfect weather for sectors like financials, because they benefit from more lending and consumer discretionary. We're talking cars, vacations, shopping, as people finally start opening their wallets again. And this, right here, gets to the trickiest part of the whole thing. It's so counterintuitive. The best time to jump into these recovery stocks isn't when the news is good. It's at what they call the point of maximum pessimism, when things look absolutely awful. That is the exact moment the market, which is always looking ahead, starts pricing in the rebound that nobody else can see yet. So for decades, this economic clock was a pretty reliable map for investors. But what happens when a new force comes along that just doesn't care about the seasons? Well, that's the great disruption we're living through right now, and it's being driven by one thing: artificial intelligence. So this creates this fascinating tug of war in the market. You've got your classic cyclical trends, right? They're tied to the normal 1 to 5 year business cycle. But then you have these massive multi-decade tidal waves called secular trends, things like the rise of the internet or now AI. And these trends can often just power right through the shorter-term economic weather. And we saw the raw power of this AI secular trend back in 2024. It created what everyone started calling a narrow market because investors were so obsessed with the promise of AI that they basically poured all their money into just a handful of companies. And the result? Just look at it.
These 7 giant tech stocks delivered insane returns, while the rest of the market, almost 500 other companies, was just left in the dust.
But by 2025, the story started to get a lot more complicated. The whole idea that you could just buy any big tech stock and win, that started to fall apart. As you can see, the performance started to spread out wildly. The companies that were really at the center of building the AI, like Alphabet and Nvidia, they kept soaring. But for others, the hype started to wear off. It was a huge reminder that even inside a massive trend, a company's actual performance eventually starts to matter again.
So, what's all this mean for investors today? Well, it's not that the classic economic clock is broken. It's more like there's a second, much more powerful clock running right alongside it. The modern playbook is all about learning how to read both of them at the same time. So, the new challenge really is analyzing 2 different stories at once. You still have to track that traditional economic cycle, watching interest rates and GDP, but now you have to overlay this incredibly powerful, long-term disruptive force like AI on top of it. And the two are always interacting, always pushing and pulling on each other. And this brings us to this idea that's getting a ton of attention on Wall Street. Goldman Sachs has a cool name for it, the tectonic. The idea is pretty simple. Phase 1 of the AI boom was all about the companies that were building the AI. But phase 2, that's going to be about all the old economy companies that figure out how to use that AI to completely change their businesses. We're talking manufacturing, healthcare, energy, you name it.
So, with that in mind, let's take a look at what some of the biggest names on Wall Street are getting ready for as we head deeper into 2026.
And what you're seeing here is a really clear consensus forming. The market is about to broaden out. After years of just a few big tech names running the show, the major firms are betting that leadership is finally going to pass to other sectors. You can see the themes here. Things like a rebound in mergers and acquisitions boosting financials, and this new focus on real-world sectors like healthcare and commodities.
And a huge potential catalyst that could drive this whole shift is a new wave of government spending. Just imagine a big bill that pours a ton of stimulus directly into American manufacturing. That kind of policy is designed to do one thing, really: create a boom for domestic cyclical sectors like industrials and materials, and kind of insulate them from whatever's happening in the rest of the world.
So to really navigate this new market environment, investors kind of need to master 3 different skills. First, you still need that classic macro forecasting, reading the economic seasons. Second, you have to understand how different markets, like bonds and currencies, all affect each other. And finally, you have to follow the money, tracking in real time where the big institutions are actually placing their bets.
Look, the strategy of sector rotation is an invaluable map for navigating the market's cycles. It just is. But as we've seen, the landscape itself is being redrawn by these massive new forces like AI and fiscal policy. And that leaves us with the most important question for any investor, which is, as the old playbook changes, what new force is going to drive the next great rotation?